Have you ever wondered why financial market crashes always seem to catch everyone by surprise? One day the headlines are glowing, and the next, panic is everywhere. But what if I told you that for the world's largest pools of capital, these collapses are rarely a surprise? While retail investors are riding the wave of optimism, the so-called big money is often already making quiet moves, long before the storm hits. This isn't about predicting the future. It's about playing the odds, managing risk, and following signals that are invisible to most. Today, we're pulling back the curtain to reveal the secret playbook of big money and the patterns they follow before a market downturn. These patterns repeat throughout history, and understanding them can change how you see the markets forever. So, what's the first thing big money does when it senses trouble? It doesn't hit the big red sell button and run for the hills. That would cause a panic and hurt their own positions. Instead, the process is subtle and gradual. It starts with trimming the fat. Months, or even years, before a crash, large funds begin quietly reducing their exposure to the riskiest assets. Think about speculative tech stocks with no profits, companies loaded with debt, or assets that only work when money is cheap. They start selling these off, bit by bit. The market might still be climbing, the news might be full of success stories, but behind the scenes, a slow and steady rebalancing is underway. The goal isn't to perfectly time the top, but to simply reduce the potential damage when the tide eventually turns. One of the loudest alarm bells for institutional investors is extreme valuation. They look at metrics like the CAPE ratio, which compares stock prices to their long-term earnings. When this number gets into historically dangerous territory, it's a sign that market hype has completely detached from reality. This happened right before the dot-com bust in 2000 and the Great Crash of 1929. In the late 90s, while the public was obsessed with soaring tech stocks, many large funds saw that valuations were higher than at any point in the 20th century. They didn't sell everything at once, but they started cutting their most overvalued positions. They knew that eventually, gravity would kick in and prices would have to return to something resembling their fundamental value. But stocks are only half the story. Often, the real warning signs appear in a place most people ignore: the credit markets. This is the plumbing of the financial system. Long before stock prices fall, the cost of borrowing for riskier companies starts to creep up. Big money pays obsessive attention to something called credit spreads. That's the difference in interest rates between super safe government bonds and riskier corporate bonds. When this gap, or spread, starts to widen, it means lenders are getting nervous and demanding more compensation for taking on risk. A classic example is the lead-up to the 2008 financial crisis. While the stock market was still hitting new highs, credit spreads on mortgage-backed securities were exploding. It was a five-alarm fire in the financial system's basement, signaling that the very foundation was cracking. Those who were watching this signal knew it was time to get out of the way. Another critical move big money makes is a flight to liquidity. In times of uncertainty, flexibility is king. Cash, short-term government bonds, and other assets that can be sold instantly become incredibly attractive. It's not because they offer amazing returns, they don't. It's because they offer something far more valuable: options. Having cash on hand means you can weather a storm without being forced to sell your best assets at the worst possible time. It also means you have the power to move quickly and buy up incredible bargains when everyone else is panicking. If you look back at periods just before major crashes, you'll often see a rising demand for safe, liquid assets, even while the stock market party seems to be in full swing. It's the financial equivalent of stocking up on supplies before a hurricane that only you can see on the radar. But it's not just about selling and hoarding cash. A lot of the action happens through rotation. Instead of abandoning the market completely, big money reallocates capital from high-flying, economically sensitive stocks to defensive sectors. These are the boring but reliable industries that people need no matter what the economy is doing. Think utilities, because people always need electricity. Healthcare, because people still get sick. And consumer staples, because everyone needs to buy groceries and toothpaste. This rotation is a slow, methodical shift. It's not dramatic, and it's often completely missed by retail investors who are still chasing the hottest momentum stocks. But over time, this quiet movement reshapes the market's leadership, a change that only becomes obvious to everyone else after the downturn is already underway. The chessboard for big money is global, so their moves extend to currencies and countries. When financial stress is on the horizon, capital starts flowing towards currencies and regions that are seen as safe havens. This isn't about finding the next hot growth market. It's about finding stability. Big money asks, which country's financial system is least likely to break under pressure? Capital gravitates towards places with strong legal systems, deep financial markets, and a proven ability to manage a crisis. The US dollar, the Swiss franc, and other stable currencies often see huge inflows. These capital flows are like slow-moving tectonic plates, silently reshaping the global financial landscape long before the earthquake hits and the headlines catch up. Beyond specific assets, big money also changes how it thinks about risk itself. Volatility isn't something to be feared, it's something to be priced. Institutional investors constantly monitor the cost of borrowing, the availability of credit, and the general level of leverage in the system. When credit tightens and it becomes more expensive to borrow, it's a sign that the market is becoming less forgiving. The margin for error is shrinking. Even if stock prices are still high, this underlying stress in the financial plumbing is a clear signal to reduce risk. It's not about predicting a definite collapse. It's about recognizing that the odds are shifting. When the potential downside starts to outweigh the potential upside, smart money quietly steps back from the table. Now, for one of the sneakiest tools in the institutional playbook, hedging with derivatives. Instead of selling off a huge chunk of their stock portfolio, which could trigger a sell-off, a large fund might do something much quieter. They can buy put options on a major index like the S&P 500. A put option is basically an insurance policy. It gives them the right to sell at a certain price. If the market tanks, the value of these put options skyrockets, offsetting a portion of the losses in their stock portfolio. This activity is mostly hidden from public view, but analysts watch a metric called the put-call ratio. When the demand for these protective put options surges relative to bullish call options, it's a strong sign that smart money is quietly battening down the hatches, preparing for a storm without shouting fire in a crowded theater. Perhaps the most underrated superpower of big money is patience. They don't panic sell at the first sign of trouble, and they don't jump back in at the first glimmer of hope. They wait. When a real downturn hits and fear takes over, prices can fall far below their true value. This is when liquidity, which they patiently built up earlier, becomes a weapon. The cash they preserved can now be deployed to buy incredible assets at fire sale prices. Distressed companies, undervalued stocks, entire sectors sold off in a panic. This is where the real fortunes are made. It's a powerful reminder that the best opportunities often appear not during the roaring bull markets, but in the wreckage left behind by crashes. Finally, big money often acts as a contrarian, moving in the opposite direction of the crowd. There are sentiment indicators, like the AAII Investor Sentiment Survey, that measure how bullish or bearish individual investors are. History has shown time and time again that when retail investors are overwhelmingly optimistic and euphoric, a market top is often near. Conversely, when they are utterly pessimistic, have sold everything in despair, and are convinced the world is ending, that's often the point of maximum opportunity, the market bottom. Big money understands this dynamic perfectly. They are often the ones on the other side of the trade, calmly buying the assets that panicked retail investors are desperately selling, accumulating valuable holdings at deep discounts. In the end, the movements of big money aren't driven by gut feelings or dramatic predictions of doom. They're driven by structure, risk management, and cold, hard probabilities. When the potential for reward shrinks and the risk of loss grows, capital quietly pulls back. When fear is at its peak and bargains are everywhere, capital quietly steps forward. Market collapses might feel sudden and chaotic to the public, But for those who know where to look, they are often just the final, dramatic act of a process that began long before the first alarm bell ever rang. Understanding this doesn't mean you can beat the market, but it does give you a new lens to see through the noise, recognize the cycles, and make smarter decisions for your own financial future. Thanks for watching, and if you found this valuable, don't forget to like and subscribe for more insights.